I'm good. I'm good. Sorry, I'm a little late.
Nah, you're right,
No,
brother.
no, no, you're all good.
We've
Yeah,
only just
so
started.
today we're going to talk about market structure. We talked about this last time, but we're going to go into a lot more detail into market structure because when you guys first hop on the charts, it's the first thing you'll look at is
We need
what
to just
kind of market
zoom
are
in a
we
little
in.
bit. It's just a bit hard to see all your shit.
So it's important to understand market structure because you need to know one, what type of trend we're in. So what are the there's three types of trends if you guys remember. So we have one where we're bouncing in a range, so it looks something like this, right? And what this is telling us is that price is not sure which way it wants to go, right? So price is trading within this little bubble here, and we haven't gone long or we haven't gone short, right? So we call this a consolidation. Price is
Consolidations.
consolidating. Consolidation station is what we like to call it. And often this is when your patience will actually really be tested because
Especially if
you'll
you're a noob.
see, yeah, especially because you'll see price come up here to these highs, then you'll see it come down, and it's a whole barrel of emotions. But so after a consolidation, or not after, but the second type of trend that we have is a bullish trend, which is also uptrend. So what does that look like? Is if we break out of said consolidation and do something like this, and who remembers what needs to happen or what these areas are called?
You guys, like, honestly, I feel like just if you know what we're saying, just kind of yell it out. I wanna see how I wanna hear you guys learning it with us, type of shit.
Yeah. Because remember, if you're wrong, it's the best place to learn right now before before you enter the market and you're wrong. So
Sweet.
we'll warm up to everyone, and I'll answer this one. But so for us to see an uptrend or a bullish trend, we need to see the consolidation break, which is this, and we need to see price putting in what we call higher highs and higher lows. And that's how we can tell if it's an uptrend. On the opposite side of things, what comes up must come down. So we have something called a bearish or a downtrend. Right? And what happens there is you can imagine or guess the opposite of an uptrend. So this is when the market decides to put in lower highs and lower lows. So this is what we touched on last week, right? So we understand the three different types of market structure: your consolidation, your bullish, your uptrend, and your downtrend. Now we can touch on what type of people are trading these markets, which I think Nathan, you're better off doing.
Sure. So with this shit, um, excuse my French, but when you are in the two separate types of markets, you've got, there you go. So you've got your uptrend, like Nijat was just talking about, and then come up, and then you got your downtrend. So essentially, with something like this, I'll just make it a bit easier to see. So there's your uptrend, and then there's your downtrend. This looks a little bit confusing at the moment, but bear with me. It's about to make sense in a second. So the way you kind of got to think about it when you are looking at this type of stuff is essentially the market's built up of a battle of buyers and sellers. Um, so when the market gets to certain positions, you've got institutions and corporations within the market competing against the retail traders. Retail traders are essentially trying to beat the institutions and the corporations, and then vice versa. So the institutions will be trying to stop all the retail traders out of the market and take their money. So essentially, within this game, you don't make money, you take money. We did touch on that last time as well. That within the price markets, the money's already in circulation. So any money you put in, someone has to be taking out. So when someone gets stopped out, someone's essentially filling their order. So for orders to get filled, sellers need to be taking profits or taking the loss, and buyers need to be buying I guess their shares that they've bought or sold. So essentially, when people get into these types of points, so these points here, when they're wanting to buy the market, they're essentially looking at the viewpoint that saying that, look, the price is cheap. I'm going to get in at a good deal. So they'll buy in, or you will essentially get investors where people are wanting to buy in long term, push the price up, and then take their profits. So then it's like vice versa. Once you get to the top of a trend or somewhere of a high point, maybe here, maybe here, the people that have got positions might think that that's a very good time to take their money out of the market. So that will essentially push the price down. But then also there's people that think that the market's probably at too high of a price. So then they might sell the market and push the price down again. So you've got it's essentially a battle between the buyers and the sellers of the whole market. So that's what I kind of mean that the market wants to stay in equilibrium always. It's always going to stay at that middle point because obviously everyone's got their own different bias for where they think the price is going to go and where they think the price is valued at. So you're essentially got psychology on the chart showing people either it's overbought or it's undersold. So there's different ways as well that institutions will try and take your money with people kind of knowing this. They'll essentially try and get people within a trend. I'll redraw this. Just give me 1 sec. They'll try and push people.
Yeah, I think we have to explain what classifies a trend first, Nathan. So,
All right.
yeah, so when we look at market structure, so if you're looking at Nathan's screen or my screen, it is confusing because we're both sharing. But where you see price make highs and lows, you wanna it's only a valid trend if you can draw a line on it and there's 3 points touching, right? Like this. So we've drawn a line and all 3 of these points here are touching, right? So you have 1 point there, another point here, and another point here, right? Which makes this a valid trend. If this, however, let's say this high down here was actually like this, then your trend wouldn't work, right? Because you don't have three areas of it touching. A lot of trading and a lot of the technicals that come into play does work with the power of 3. It is a very important number, and it just gives you more evidence per se, right? So if we look at like a real chart, I'll just go on this 1 hour chart and we can see if we can identify a trend, right? So here, if we wanted to draw a line from this top, you'd look at where the trend touched 3 times. And as you can see, it's a very big channel, right? Because we have this high up here, which stops a nice looking trend. Whereas if we went closer and looked at, let's say we wanted to draw what trend this area is looking at, from like here to here, then we would look at the highs and we would draw our trend down. Again, we only have 2 touches, right? So this trend line doesn't actually make sense. It's not a trend line that we can say will get respected in the long run. If we had a 3rd touch on this trend line, then we could say that this trend line is in fact a valid trend line. And this goes for both ways, right? So you could draw it on the bottom side and the top side. So I'll just do a new drawing here.
So just
So
kind of building on what Najat's saying, essentially within rising markets, your trend line would be on the underlying support. So the support's essentially, you've got to understand, almost like a shelf. The support would stay underneath and support anything that's on top. So like Najat's kind of drawn there, it's pushed up, it's come back, and it's respected that support line in the pink. It's come up again, and it's still respected that same support. This is like a diagonal kind of. Oh, that's your resistance niche. And then when it's a falling market, so when it's like when the market's coming down, essentially the markets will respect the resistance. So the resistance will be that top. So as it's falling and comes up, it will hit that resistance. So you essentially want to plot your trend lines. For your rising markets, you want to plot it on the support, but then on the falling markets, you want to plot it on the resistance. So when you see a break on either side, hold on, I'll get an example up on my screen. So essentially here, this is the quickest one I can see. Sorry guys, I'm making you jump from live to live. But right here, let's start here. Essentially, you would say that that's your trend line. But as soon as it's broken down through there, you can see that the trend's not valid anymore. So this would be what you call your support line. It keeps bouncing off this. It's not quite as nice as you'd kind of like it, but it's still kind of showing where the market's actually moving. It's bounced through, it's pushed through, but it hasn't found any strong momentum to keep going down. Pushed up again, bounce, 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 and then it's pushed through with pretty strong succession. So you can kind of tell when your trend line breaks, and then with this, you would go on the top. But this is not as nice. And then this, you'd almost print like that. But yeah, that one's not as nice. But yeah, your trend lines can get a little bit confusing because obviously something like this, you might think that pushes up through into an uptrend, and then it stays respecting the trend line and ends up falling back through. So your trend lines are like an idea to give you a bit of confluence when you are trading, just so you can see where the actual market's going, because obviously that stays there for around 2 days, and then it breaks, then it pushes through. Same thing, your trend line, you're in a downtrend. That's how you kind of know where to take your bias. So if your trend line's going down, you don't want to be longing the market or buying and going up. You essentially want to be, like I said last week, or like we said last week, you want to be trading with the trend. So following the market down to give you the highest probability that your trade's going to play out. Just like, I'll show you one of the examples, like today. Today, we put a few trades in the actual chart itself. This is just on the 15 minute. It's in a downtrend, and you can kind of see just an underlying support, and then it just moves down. Even though it keeps moving up, you don't know how high it's going to go or how far up it's going to go. Same thing here. It started to stagnate here, but yeah, you're still trading with the trend. So your bias you should be trading with your bias on the days that you can see the market kind of moving in that trend that you're kind of taking, if that makes sense.
Exactly. And the more price touches your trend line, the more valid that trend line is. Meaning that when price eventually decides to break out, that's when you can expect a really big push. So we see that price is trading in this trend here. If we happen to go here and then we break the trend, you can expect two things, right? It's either what we class as a fake out, which means that the institutions are getting sellers involved in the market because they know that they're looking at this trend and they see a breakout, and then it will go back into the range. Or many times you'll see it is once it breaks the trend, like Nathan's example before, you'll see it just shoot down, right?
See, a lot of times as well, it might come back up to the trend line to retest it, and then come back down. So
Yeah.
that you're always going to get opportunities to get into positions and fill orders, but yeah, the trend lines. There's something you use a lot at the start just to figure out where the market's actually going, but towards like once you start getting a bit more experience, you kind of see where the actual trend's going, and it'll make it just give
Yeah.
you that a little bit more reassurance.
Exactly. Like the first thing that we want you guys to be able to do is hop on a market and legit just draw your trend lines. So I would like you guys should be able to at least this time next week, we hope, is to go on a market, be able to draw a trend line with 3 points, and you guys will be able to then deem it if we're in a downtrend, uptrend, or consolidation station, right? That's almost stage one of it because like we said, we go in every day with a directional bias. Like today, our bias was shorts, right? So what do we do today is, like Nathan said, we knew that we're in a downtrend. So it was just a matter of waiting for price to get to a nice area for us to then short the market.
And honestly, the waiting game is probably 80% of trading. Um, you're you're really going to test your patience when you kind of get into these types of positions, because firstly you're going to have to wait for your position to run and hit its take profit or wherever it's supposed to be going, but also you're going to be waiting for your position to actually get to where you want it to be rather than impulse buying or impulse selling. And then you're too early or too late for the actual position. More often than not, you're too early, and you get your shit kind of thrown up in your face, and you lose money, and it's not that fun. But like, yeah, the more you guys do it as well. Like, obviously, we're just starting, but once you guys do get accounts, you'll start realizing a lot of this stuff, more the psychological aspect of it. When I first started kind of teaching the JAT, that was probably one of the first things that I did touch on. That the actual psychology of this game is probably 80%. Um, yeah, you really have to. You really rediscover yourself in a way to see where your greed, your fear, just your underlying emotions are. Um, but yeah, you obviously we grow and we learn to kind of this game teaches us to kind of grow past that and get better, obviously, with your emotions and just taking these positions and yeah, just being more disciplined as well.
Exactly. So there's many different things you can do with a trend, right? Because we know that we can look at like when we look at charts, we can look at them in multi time frames, right? Like we know that the candles here are on a 1 hour basis at the moment. We can look at it on a 4 hour basis or a shorter basis, right? And that's the power of using bigger time frame trends to then go down to a smaller time frame and execute on those positions, right? So let's say like for instance, this trend here that we drew up before, let's say this was on a 4 hour time frame, right? And here we're at the prices at this point right now at the top of this 4 hour trend line, right? Statistically, we can expect price to reject this and come down on a bigger time frame, right? But we're not going to sit and wait 4 hours for each candlestick to print. So what we'll do is we'll go into a smaller time frame, like the hourly or like the 30-minute or the 15-minute, and then we'll look for price to reject off of this area, and then that's when we'll take our short for price to eventually continue the trend down. A lot of what you do with what we teach you will come out of your own skill in the sense that everyone has their own way of trading it, but identifying a trend is essential in everyone's trading plan. Whether you want to trade the trend, like I just said, is up to you. It's not exactly how I trade, but it is more than likely going to play out if you do follow this type of market.
Nijay,
Yeah.
what do you reckon the best time frame to look at is?
So what I do is I always start off on the daily time frame. If I'm on the market on Monday morning, then I'll look at the weekly time frame because Monday is a brand new week. It's the start of a brand new week, right? So that means that we have a close of last week's candle, and that closure will tell us a lot. Like right here, so right now we're on the weekly chart, right? And if we look at this previous candle, so this was last week's candle, we can see that it's a bearish close. It's a downward close, right? So we can kind of predict or assume that this week is more than likely to continue to be bearish. You also look at areas of resistance and areas where price kind of didn't have any like decisions made, if that makes sense, on the bigger time frame. So on the weekly time frame, we can see that there was a lot of indecision right here, right? And if we zoom in on a shorter time frame, this is going to be a very, very vague, big box that we're going to be able to play within, right? But we know that when price enters into this box, at least in these 3 weeks in a row, price came down to this level here. So what can we almost do is on the weekly time frame, we can mark out this level here, right? Knowing that price could likely come down and fill these ranges, right? And that's on the weekly. What else you can do on the weekly is you can identify a trend. So here we can see that we were downtrending, right? We were coming down here during all these weeks, which was what 2021 to mid last year, big downtrend. What happened here? We reversed. So late last year, price decided to reverse, and it looks like we're now in an uptrend, right? Because what do? We're making higher highs, and we're making higher lows. So on a weekly bias, we know that we're in an uptrend. So then after doing my weekly analysis, I'll drop down to the daily, which represents today's candlesticks, right? And this just paints the picture a bit more. So here we can see where price rejected those 3 weeks, and we can
Did Najat just die, or did I just die?
see now on the daily. Like, can you hear me? You can hear me? I think it was you, Nathan.
Oh, okay, sick.
You good?
Yeah, I'm good.
So that's your weekly and your daily analysis, right? So that should be done at the start of the week. Your weekly will be done, and then on the daily, you do it at the start of your morning, right?
Wait,
And
just
then when you actually
one quick thing as well that I probably touch on as well is like before you do any of this, you probably want to be looking at the news just to keep it in the back of your minds, guys. Like the news is probably one of the most important things that you want to be sussing out for the day, just to see if there is any major news, because yeah, that could change the whole. They could flip the whole day essentially and flip the whole week almost.
Yeah, we'll talk about news a bit more in depth because news is another one of those things like sessions that kind of give you volume. And we know that we want to trade in volume markets. We want to trade when price is moving and not stagnant. Right, so from the daily, then I'll always go down to my 4 hour. 4 hour candles are very, 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 very strong. They tend to hold the most weight when it comes to probability, in my personal experience. So if the 4 hours telling me one thing, I'll tend to always look at the 4 hour, right? And what's this 4 hour telling me now is that price is rejecting these areas up here, and it looks like we came up. If you see on the right hand side here, this 4 hour candle, so it looks like in that 30 minutes we came up, almost created this top wick up here, right? And I can kind of predict, or I can kind of say without a crystal ball, that I think that this is going to come down, right? And that's on the 4 hour. So then I drop down to either a 30-minute, 15-minute, or 5-minute. It depends on what you like.
What makes you say that it's going to come down?
So we have to explain price action, right?
Yeah, but just go on. Just quickly,
So
the
quickly
wicks
off,
and the candles.
yeah, exactly. So we know that candlesticks have wicks and they have bodies, right? And 9 times out of 10, these bigger candlesticks, as you can see, almost all these candlesticks have wicks on both sides. It's very rare. There's a example here where there's no wicks to the downside. It's very rare, but more than likely you can expect a wick to be created. And in a 4-hour time frame, it's a very long time. So you would need for this to not come down and make a bottom wick or make a bearish candle, it means that price is very bullish. So price is going to continue to move up from this point in the next 3.5 hours.
Juicy.
That's touching on something we called price action. And we'll get into price action later in this session because it looks solely at candlesticks. But you need to first know the different types of candlesticks and what candlesticks are actually representing. But back to the time frames. So yep, that's the 4-hour. And then, like I said, you can go there. I like the 30, 15, or 5. Any of these work. It depends on what type of trader you are. So I tend to kind of go off the 5. I look at all of them, but my entries come off the 5 or the 1 minute. It doesn't mean that I'm not looking at the 30-minute and the 15-minute candles because they are also important. But when it comes to actually entering the market, I'm usually down on a 5 minute or a 1 minute. And it just comes down to precision, right? The smaller time frames means there's more candles printing. And with more candles printing, it means there's more data that you can look at. So you're doing less crystal bowling and you're looking more at price, seeing how it's reacting and making a decision off that, right? Like we said before, on the 4-hour chart, we think that this is going to come down. But from here, there's nothing saying that. It's just me looking at this candle that's currently being printed. But if you go down to a smaller time frame to actually see what this 4-hour candle is doing, you can see that we've come up to this area and now we're rejecting it. So that's how I kind of use my different time frames. Yuvash, if that answers your question. There's lots of different strategies out there. There's people that use strategies that purely look off 4 hours. So in a day, there's only 3 4-hour candlesticks that are printed, just due to the session times. So each 4-hour candlestick will kind of tell you how that session played out. And people trade just off that. People trade off the 5-minute chart, but I think using your multi-time frames is the best way of doing it because it's there for a reason. It's there for us to be able to tell the story, and like we said earlier, we know the bigger time frames, the 1 hours, the 4 hours, the dailies, the weeklies, they're going to hold a lot more value in terms of playing out right. So it's getting those higher time frame analysis and bias correct, and then going to the smaller time frames just to execute your trade, just to see what's actually happening within those bigger time frame candles.
So essentially, as well, the higher time frame you go on, the slower the move is going to be. So that's why we enter on the 5 minute, just because we're going to get a quicker move to see. If you just want to put a position on just quickly, if we compare, so let's just say for Najat's sake, or for example's sake, Najat's just put a position on. That's obviously going to hit a lot quicker if we did the exact same position on like something like a 4-hour or a 1 hour. Essentially, the higher you go up in time frames as well, when you plot your positions, you give yourself more time to actually let the position run, but like not let it run in your I guess your favor. So like.
Exactly, right? So if you're basing your analysis off a 4-hour candle, it almost means that you're going to let the whole next 4 hours play out at minimum for your position, right? Because you're basing your analysis off previous price action of 4 hours. So you can do that, but if you go down to the smaller time frame, like Nathan said, to the 5, to the 1, to the 15, these candlesticks print a lot more quicker. You can get a lot more precise of entries, meaning you're in the trade for less, but the reward is the same, if that makes sense. And risk to reward and position sizes, profits, losses, it all goes within your system. So it's all based on what type of system you're going to trade, which is something that we'll get into like in a few weeks, I would say, or maybe next week we'll start to touch on it.
Yeah, we can start looking at
Because
it. Yeah.
yeah, because like as a little bit of like a trailer, there's lots of different types of traders. So you could have like a really low win rate, meaning you could take 10 trades a day and you could win maybe 2 of those trades, but you could still be profitable, right? And all that means is that your wins outweigh your losses. Or
Just
conversely,
a
you could
screenshot.
have a really high win rate. Yeah, and this is Nathan can show a screenshot of exactly this. So it's a matter of keeping your losses small and your winners big.
No? No.
We can see your screen, Nathan. You can just put it on your screen.
Oh, okay. Oh, might as well just upload it so everyone can just have a look at it. I don't know.
That's payslip, bro. Is it gonna be that?
What? It might be, man. You don't know. Wait, hold on. Alright, so here it is here. So this is like the trades for today. Can you guys see that?
Yeah.
I feel
You
like
gotta
it's
zoom in.
very small. Dude, I don't think
I
I can.
can't see. Where do I see it?
It should be on. I've just gone live on mine.
Um,
Can you guys see that?
Yeah.
So essentially, you want your winners to outweigh your losers. So right here, my last trade of the day. But essentially, I've had a few losses, but my one winner makes up for the losses, and then the next win will put me into even more of a profit. So you want your strategy. You want your strategy to know that you're going to lose, essentially, but you want your one win to outweigh as many losses as you want to wait for, essentially. If that makes sense. So, for example, you can, like I said last time, when you trade, you go off the risk, not the reward. The risk is how much essentially you're willing to put on the line to make a profit. So maybe you might risk $100. That's how much I'm risking at the moment, which is 1% of my account. Normally, what we'd say is you'd want to risk 2% at most of whatever account size that you've got. But you want to have like a 1 to 2 minimum risk to reward ratio. So even if you lose half your trade, you're still going to come out with a profit. So you essentially want to come into this game with a mindset of being okay with losing. Because it's not going to feel good, I can promise that. It's going to feel like shit. But until you start like not suppressing those feelings, but just accepting them for what it is, just moving past it, just the mindset of okay, the next trade is going to be the winner. Then this will essentially you're going to have winning streaks and losing streaks, but the winning streaks will get you into more profit, and the losing streaks you want to take them out with 1 or 2 trades at most, type of thing.
Yeah, and like not to like counter react to what Nathan's saying here, but it really depends on the type of person you are. So like if you're a person that hates to lose and a bigger win rate is more important than you, it is more important for you, sorry, then you can be a win rate trader, right? Which means that you take lots of small wins, but you just win a lot in the market. So you have real deep stops and you take profits early. Or like Nathan said, you could be a calculator trader that looks at a 1 to 2 risk to reward, meaning that you could take 2 losses and 1 win will make you a break even. Right? So it really depends.
You could really even be a 1 to 10 trader. So maybe you take 5, 6 losses, but you're waiting for one good setup to really just take you just sky high type of thing.
Yeah,
Like,
exactly. And this will all come down to, when we look at your trading plan and when you actually write up your trading plan, this is a essential part of it because we all have to have rules for your day, right? Like you want to treat this like a business. So you want to say that, once you take enough losses or you have like a capped amount of percentage that you can lose in a day, like personally for me, it's around 2 to 3%, meaning that if I lose 2 to 3% in one day, that means I'm done trading. No matter how good the setup is, no matter how much the rocket ship has fueled up before it's going up, I can't take that trade that day, right? Because it's my rules and I wrote it there for a reason. And taking losses causes your psychology to go out the window.
yeah, so essentially, you have to be as comfortable as possible when you're trading. I know that sounds fucked because you're talking about having to be losing and this, that, and the other, but you have to be comfortable with the actual plan that you build yourself. So you have to be comfortable with the amount that you're really wanting to risk. That's first off, because you're going to have to adjust to actually losing that much. If it's too much, then you're going to know about it. If it's too little, then you're not going to care enough about it, and you'll just put trades on willy nilly. But you also need to be happy with how much you're winning as well. Not just the amount, but also the frequency of your wins. Because like if you get yourself into a losing streak, you can really neg yourself out, and then you start thinking that there's something wrong with yourself or something wrong with your trading plan, and you start switching, you start changing things up, even though there was nothing wrong. It's just the market, maybe 2 days, 3 days that it just wasn't a good day.
Yeah,
Yeah.
exactly, right? Like, for example of this, like, both Nathan and I yesterday, we sat on the charts for like 3 hours and we didn't even get a position,
We both
right?
just got
Because,
rolled.
yeah, because the market structure was just so shit. It was so choppy. And there's a lot of reasons for this. And it's a lot of reasons, like, there's a lot of reasons why markets tend to consolidate. And it's usually leading up to, a piece of news coming out or maybe a session opening, something of the sort
Yeah, like
that will
something's about
give
to happen type
a
of thing.
drive. Yeah.
So
Because the
people are,
longer a market will consolidate, i.e., the longer the market bounces in one range, so it goes up and down, the longer that happens, when it breaks out, the bigger breakout you can expect.
the bigger the move. So
Yeah.
imagine it in that way that the runners he's trying to get that momentum going uphill, but he's essentially sitting on a park bench, gaining his breath until he's had a good feed, had a big meal of KFC, some few wings, and he's ready to sprint. That's essentially
KFC before running?
yeah. So
Like it.
the longer he waits and rests, the more energy he's got to just blast off. So yeah, just imagine the consolidation because the markets will consolidate for 80% of the time. It's annoying, but it's just what it is. Um, but the consolidations are essentially opportunities. You just don't want to trade them, but you can find entries within them where you think your bias is, and then you can sit and hold and wait and expect for moon landings to happen, type of thing.
So we went on a bit of a tangent, Yuvash, but I hope I answered your question. So to keep it short, I look at the weekly, and then and then I will always enter off of the 1 minute or the 5 minute. There are like times where I'll enter off like the 1 hour and stuff like that, but it all comes down to like strategy, and it's something that I'll like will touch and teach you guys later of like candles flipping and things like that that show strength.
See,
Which is
even
probably what we can get into now, right? Candlesticks.
yeah, I'm down. Like, but just quickly, even like just saying the difference between mine and Najat's trading style, it's almost the same, but it's completely different. Like, we still both
Yeah.
trade break and retests, but the way he does it compared to the way I do it, like I look at the 1 hour and 5 minute. That's it. That's all I look at. Where he probably does a little bit more in depth analysis. Maybe
Yeah,
the 4 hour as
exactly.
well if I kind of need it, but Yeah.
Yeah, it's just all like it's all added reasonings, right? Like if your analysis is correct on the 4 hour, but then every other time frame's telling you no, then obviously it's hard to trust it, right? But if your analysis on the 4 hours, right, and then on the 1 hour, on the 30 minute, on the 15 minute, if it's all telling you that your analysis is correct, then it's just more reason and more confidence for you to jump into the trade.
See, a good reason as well is why we started this is once you guys start getting up to speed with actually knowing how to analyze the markets, then it's just going to be a lot easier for you guys to trade the markets, just trading with us kind of thing. Like when me and Nejat go through things, we'll start from top down. So you do top down analysis. You start at your 4 hour, you go to your 1 hour, and then your 5 minute. This will essentially just give you all the confluences and see where the trend's going and whereabouts it's rejecting and just things like that. But when two heads are working together to kind of see everything, I might not see things that he might see, but he might, like vice versa as well. And then when we've got as well you guys, when you guys are trading and doing your own thing, it's just got to be extra confluences, and we're going to see things that you guys might not see, and vice versa as well. So it's essentially we're building this to kind of so we can all do it together, but we can all kind of make a bit of money and have a bit of fun and stuff like that together as well. It's the more people that do it, the easier it's going to be, in all honesty. And this game isn't
Exactly.
It's really not. It's look. It's hard, but it's really not that hard. The hard part is honestly just your own emotional scales and stuff like that. Figuring out your own brain.
Honestly, I love it. Every time we explain something, we always go back to psychology.
Oh, you
It
guys are
just
gonna.
shows how important it is, guys.
You guys are
Like
gonna
we just wanna we
understand.
can't stress it more enough. We
I'm
can't
ex-
stress it enough.
I'm excited for when you guys actually like feel it, and then you'll be like, "Fuck, this is why they were going on psychology so much." 'Cause it's
But alright, let's
important.
move on though.
Yeah, we're
Let's
gonna go
move on. So
into some candlesticks.
yes, so we understand market structure now, right? So we understand the three different types of markets, which is consolidating, a bearish, a bullish, and all of that, right? What do you better do?
Bruh.
Um, so now we're gonna talk about candlesticks, right? And candlesticks is important because, like I said before, it's price action. And candlesticks, printing candlesticks and previous candlesticks tells us the strength of what's happening, right? Each candlestick means something else. And there's different types of candlesticks that can print that kind of indicate one thing or another, right? I'm about to flick up a cheat sheet and we'll go through the cheat sheet. But before we do that, I just wanted to make sure that we all understand what a candlestick is again. So, like we said, you have a body. This is your main part of your candlestick, right? And if this is bullish, so if this is a green candlestick, meaning that price is moving up like this. So in these areas here, when price is moving up, you'll see green candlesticks form, right?
Well, this
And the
essentially
bot,
could even be its own candlestick, just that trend with the actual body itself. So that could be a 4 hour almost, with it moving up in a smaller time frame. But not sure, confused. You keep going, Midge.
yeah, exactly, right?
Getting to
So
it.
in a bullish candlestick, the bottom of the body is where we open. So if we're looking at a 5 minute candlestick, so this candlestick represents 5 minutes, right? So this bottom is the open of the 5 minutes, and the top is the close of the 5 minutes. And then you have something called the wick. So this just shows that in this 5 minutes, this was the low, and in the 5 minutes, this was the high. But price did not stay at those levels, and you can see that we might have tapped into this low, so we could have opened, the candle could have come up to maybe around here, and then it could have made this low, so it could have come back down, flipped bearish, it would have looked something like this, and then what did it do? It came back up here, made this high, so it would have looked something like this without a wick, and then it pulled back and closed here. right? So that's essentially a candlestick. And then you have the opposite of this, which is a red candlestick. And I'll just draw this out here. And this means, so it works in the same way, it's just you got to flip everything around, right? So this one will actually draw it with no top wick. So I can kind of explain what that means, right? So, oh no, we'll draw it with just the top wick. Right, so because the bullish candlestick opens at the bottom, because price was coming from this direction, now that we have a bearish one, it means that the open is now over here at this top, right? Because this is where price closed. So this is where the new candlestick starts printing. And then we have the close of the candlestick down here. And what did this candle do that was different to the other one? It has no bottom wick. It has a top wick. So what that means is when this candle was printing, it would have actually started printing like this, and it would have been green, right? Because we're moving up in price. But by the time it closed, what did it do? It came back down and flipped down. And what does this show, right? It shows that there's not enough buyers in the market to push the market to continue the push up, right? So that is essentially a candlestick. Now we'll get into this, which is, so this is a little cheat sheet that is in the journal. So this was sent to everyone. This is eventually where you guys will journal all your trades. This is where you'll have your setup. This is where your stats will be. So once you start journaling your trades, all of this will automatically calculate your stats, so you can see, you know, which quarter you perform best in, which time frame that you took your trades in works out best for you, the type of entry, and so on and so forth. I don't want to confuse you guys, but this is something that we'll go through in a later date when we start executing trades. But also you'll find this tab, right, which is your resource, your candlestick resource.
Wait, just quickly,
So-
does that all make sense? Just the basics of a candlestick? Because then this is going to start just building
Confusing you.
on that. Yeah.
Yeah.
Yeah, that makes sense. Everyone else?
Yep.
Ladies?
Yeah.
Emily?
Yeah, sick.
Yep.
Hi.
Okay, sick. So now we get into like the fun part, right? Which is what do candlesticks mean and how we can use them. So there's a lot of different patterns and a lot of different things that you can look at. This is essentially a resource that I've always just, it's honestly, people print this shit out and they have it on their walls. So like when you see it print, you kind of know what to do. It's not like you can't take trades purely off of this. You actually have to understand, you know, like what we've touched on before, market structure and things like that. But it shows you what different candlesticks mean, right? So if we start from the top left, so all of these candlesticks in this green box represent a bullish move, right? Bullish momentum, meaning that buyers in the market. And you can see this. So top left, we have something called a hammer, right? Which it has a bottom wick and then the body's up here, right? And just purely looking at this, what you could say is that price started down here and then a lot of buyers came into the market, and within this period of this candlestick, which could be a 5 minute, a 1 hour, a 4 hour, whatever it is, buyers pushed it up and we closed up here. So this shows bullish momentum, right?
Right.
And where you will see this happen.
Wait, Midge, hold on. You just said that it opened on the wick and then it closed on the body?
Okay, no, so it opened at the bottom of the body, and within the time frame it came down, rejected this area, which created the wick, and it closed back up here. That's a good catch.
I got
So where you'll see like this play out, right, is we can actually go to a live, like we can go look at the markets and we'll go look for a hammer. Because how you would want a hammer to play out is something like this. You would want to see price coming down like this, and then you'd want to see your hammer print right here, right? If you see a hammer print here, what does it show you? It shows you that the buyers have entered the market in this downtrend, and it's a potential reversal.
So
So it's a
essentially,
confluence.
it kind of shows the exhaustion of the trend. So it's pushed down, but it's failed to keep that momentum on the way down. And then it's showing essentially that the buyers come in and they've taken control. So I think the Jets just found like a perfect example there.
Exactly, right here, right? So what do we see? We see a downtrend. So we see price coming down. And then what do we see here? We see a hammer. We see a hammer form on a 1 hour. What happens after the hammer? Boom. Price starts to move up. Right? So it shows the exhaustion, like Nathan said, it shows that the sellers have been outbought in the market. Classic supply and demand. Now there's more demand than there is supply. So now the buyers are getting back in and price pushed up. What do we see over here before this reversal?
Same thing.
Go here.
But
We see what we call a shooting star. Right? Same thing. Price came up here. We're in a bullish trend. The buyers tried to keep buying up the market, but the sellers stepped in. And what followed that? A down push.
Lots of
Right?
money.
Lots of money. Lots of money. Right? So that's an example of that. You can spot you'll spot all of these happen all the time. And there's gonna be occasions where you'll see these print and price doesn't do what you want it to do. Right? That's why when you look at pure candlesticks, and if you want to trade pure candlesticks like this, you want to look at higher time frames. Because I'll tell you now, if you go down to a 1 minute, you will see hammers form all the time.
Everywhere.
And you
And
just see them just like form like this,
It's
and it
just
just means
disgusting.
nothing.
Even that, like
Yeah.
the shooting star that's just there.
Yeah, exactly.
They don't mean fuck all. Like,
Yeah.
to put it bluntly, if you're going down to a 1 minute and you're seeing hammers and you're seeing these types of candlestick patterns, like honestly, just ignore it. It's
Yeah,
it's just
exactly.
not
If you see it on a 4-hour candle, then you know. Then you know what's up.
See
If you
that
see it on a 1 hour, then you know what's
the
up.
hammer that's just happened, Nidge? The second candle in. Is that a hammer or is that doji?
It's doji.
Alrighty.
So this candle here, so this is what we call an indecision candle. Right? Because what's happened here is price has come up and it's come down and it's just closed in the middle. So this tells us that the market doesn't know if it wants to move up or down, right? And these are these 3 candles here. So any candle without any strong body is fairly neutral. So what I tend to do and what a lot of people tend to do is instead of treating it like a reversal, you just pretend it's not there. So in this example here, I would just black out this candle and I would just look at the next candle and look at the previous one. Because the market doesn't know what to do. It is good to know that though, because you know that there's no decision being made and you're consolidating. We can tell in this candle, just by looking at this on a 4-hour, that it's a consolidation. And if we go to a 5 minute, you can see this exact consolidation. You can see where this candle was, right? Which is this whole area here.
Just gone up and down.
Yeah, just bouncing in the range. So they're your 2 simple one candle showings. There's something that we both look at a lot, both Nathan and I, which is engulfing candles. So what engulfing candles are is like this one here. So if you have price printing and it's printing, let's look for engulfing. Oh, actually, this one before was perfect for engulfing. Yeah, perfect.
So,
Yeah.
just in relations to the engulfing candles, they're probably one of the best indicators for entry within the market, depending on what type of time frame you're looking at. Because an engulf, essentially, what an engulf does is it will just be bigger than the candle that came before it. So if it's a bearish candle that's just come before, or a sell candle, so a red one, and then you get a blue or a green engulf. Essentially, your engulf should be bigger than the previous candle. It should. An ideal engulf is it should engulf the wick and the body within the body of the new candle. So you want to show for it to show that it's a strong either bearish or bullish engulf. You want that whole body to fill at least the body of the previous candle, but ideally the wick and the body of the previous candle. That will essentially show you that the market's reversed first, but also that there's strong momentum on the opposite side for whatever your bias is, whether that's buying or selling. Probably two of the best candles that you can have, the bearish and the bullish engulf. That will signify that your trend is on. Look, like Najat said, don't go solely off these types of candles because you're not going to win 100% of the time. But yeah, they definitely help to know, especially when you're seeing your price action happen in real time. I have given you guys on that GWI onboarding document, right at the bottom of that is a bit of candlestick stuff as well. So that it just explains what the candles are. But yeah, they're very important in just understanding what's going on with the market and predicting where it's going to move to.
Exactly right. And don't even engulfing looks at the candle before, but you can even see ranges get engulfed, right? So this entire range in this green square, this was over like 2 days of where price slowly moved up. And what did we have? We had one candle that blew past the entire range, right? Which just shows very strong sell pressure. What came after that candle? Another big ass candle. And then even here, you could have taken a sell down here. It is late. You'd think that you missed the move, right? But what do? We continue to go down.
Just as we were saying as well before, guys, that news is probably a pretty important thing within the market. Those big white candles just there, that's probably news that has just broken.
Yeah.
And it's probably very bearish for Euro, but bullish for the USD. So it's just tanked the fuck out of Euro.
Yeah. And by news, we mean like literally like interest rates, inflation, unemployment numbers, things that will make the economy take an effect on. So we know that, like for an example, let's say news comes out tomorrow that interest rates have risen for the Australian dollar, right? So we know that that's going to be news against the dollar. And a lot of like the economics behind it is very easy to read. You don't have to know too much about it because of this website, which is something that we will go deeper into.
So yeah,
But
you go. Sorry.
Yeah, so this website pretty much tells you all the news that is going to come out today. Major folders, right? So you have 3 different types of folders. You got your yellow, your orange, and your red. Pretty much yellow means that it's going to have minor impact. Orange means it's going to have a regular, normal impact. So you can expect price to move. And red means it's going to have a big impact. So when we talk about volume and we talk about, like if you ever see Nathan and I both say in the trade channel, I'll jump back on for news later, it means that because we know that there's red folders coming out, we know that the market's gonna make a move, right? It's gonna print in one direction or the other.
Guys, I would suggest, not even suggest, should we record it? Just the news at 8:30 and just put it in the chat, just to show what news is like. Because I feel like
we can show you even yesterday, right? So this news came out at 9:45 yesterday. And if you click the folder, you can see, right? So if it's green, it means it's good news. And it will show the currency here. So we can see it's good news for the US dollar.
So
if you go look...
Just quickly, this news will print to the minute. So if it says 9:45 or whatever the fuck it was, there's going to be an instant reaction at the candle close of the news itself. So essentially, your candle close will probably close on the hour just before news does hit, and on a brand new candle, then you get the news. So I think this is news from last night.
See,
And
this is the count here. I'll clear my chart so it's a bit easier. But
Is
this
that
is
the 1
how
minute?
we would take it. This is the 1 minute. So this is how we'd take advantage of the news, right? So this is the trade I took. But this candle here, right? So you can see that price was, slowly making its way down, doing what it does, and then boom, a
That's
big drop.
yeah, printed in 1 minute. How much
So
did it move, Nidge?
it moves 47 pips.
47 pips.
So
That's a lot, essentially.
yeah, to give you guys a bit of an understanding, you want to, like, if you can catch 40 pips in an entire month, it's a good month. And this was 1 minute, right? So it just puts it into perspective that news is fucked. The one piece of advice that we will give you is you never want to try and crystal ball the news,
Yeah.
because
Doesn't
even
work
if
out.
you know the news is going to come down, this well and truly could have just came up here for a split second and then shat the bed. And it happens so quickly, and because of how quickly it happens, your broker won't be able to like feel your positions right. So it's legit how you like lose the game is trading news. It's pretty much gambling at the end of the day.
Oh, you see this guy? See this guy? Number one bullshit guy. He do the
Right. So back into candlesticks. So we know that candlesticks show strength, right? And this is why it ties back into market structure. So when you read market structure and you go hand in hand with candlesticks. So like we said before, if you see a trend happening in front of your eyes, and so let's just draw this trend, right? If you see something like this happening, and once we're up here, if you see a hanging man, a shooting star, if you see one of these combination of candles print up here, it just gives you another confluence to enter, right? So now we have two confluences. We have two reasons to enter. The first reason is we are at the top of a trend line that has been respected, right? And the second reason is we have printed a bearish candle.
Oh, you're just touching on
Going,
that, man. I don't mean to be a dick, but you'd probably want to take it at the bottom of that trend line,
why?
just because you want to be trading with the trend.
Oh yeah. So, but this is like consolidation, right? It's a channel,
Yeah, it's a channel. Yeah, true. Well,
right? Because we've had three touches both sides.
yeah.
But yeah, Nathan is right. Because it's an uptrend, you're more than likely gonna want to buy. So we'll do it like this. So let's say price is here, and let's say once price gets down to here, we see one of these candles print. So a hammer, inverted hammer. Maybe we see a tweezer bottom, a bullish engulfing, whatever it may be. It just adds a second level of confluence that we can take this buy and we can ride it back up the trend. Right? So that's why it's important to understand candlesticks, and it goes hand in hand with market structure. Because let's say that we got to this point, right? And instead of seeing one of these things print, we saw a big bearish candle print. What does that tell us? It tells us that shit, this might break the trend. So we're not going to take a buy off that. We're going to see how it reacts.
That's when your patience tends as well, because you know what you need to trade. A good rule of thumb that I learned pretty early is plan the trade and then trade the plan. So figure out where you're wanting to put your entries and where you're wanting to take it, and then just follow that suit. It makes sense, but it's easier said than done. Yeah, like honestly, today I had a trade where I was looking at making an entry, but I kept thinking that the entry was coming sooner than it did. ended up hitting the exact spot where I wanted to take the entry, but it cost me 2 losses just to get into that position. So like, always have a mental plan in your head of where you want to take it, and then take it at that spot. Like, don't deviate. If it doesn't come to that spot, don't worry about it. New times will come arise. But yeah, plan the trade and then trade the plan.
Exactly. And so another tab in the journal is called the playbook. So this comes straight from it's a trader called Don Vo who trades pure price action. And so this pretty much tells you what to look for in terms of when you're watching candlesticks, right? So these lines here, oh wow. So you can see like this grayed out line is a resistance line, would say. And you can see that the previous candle, look, I'll draw it out here so it's a bit easier. So if we're trading like this, right, and we'll trade a sell, right? So we're trading within this range here. So this would technically be a support. So down here is a support, which also means demand, potential demand. I'll keep it as support now because we won't go too into that right now. And then this would be your resistance. Right? So how would we trade this is we would look for a candle to close below or above the resistance, right? So let's say we see the candle come here, we see a candle form like this, a bearish candle. So this tells us that, okay, we've exited this little range that we're in, this consolidation station. So we've broken this support line with this candle and it's closed below. So the body has closed below the line. It didn't close like this, where it's just wicked below. Because what does this tell us? It tells us that we've rejected this support and we're going to go back into the range, right? So this candle's closed below. So what we'll do is we'll wait for the next candle. The next candle could either just shoot down, so you could take it straight off of that, or we could expect this candle to retest the support, so come back up here, and then make a wick by doing this. And then the candle would just start to drop. Right? And that would be our entry. So this would be the first reason as to why we think that there's a sell, is this candle here, which is breaking the structure, breaking the support, showing us that we've broken out this level. And the next candle is another one that's broken out. We could take this candle, or you could wait for this next candle to print to make sure that it's not going to bounce straight back into the range. And that's when you will take it. So that's what this sheet will kind of tell you. It'll tell you the many different ways that you can trade them. So here you see you have a breakout of a high low. You have a flip, which is something that we'll get into on a later date. You have celeries, you have flips, all of this, right? And candlesticks also go into your bigger time frames. So we are like, everything will slowly come together as we explain it more. But when you look at the smaller time frames, right? So let's say we look at a 5-minute time frame. So I'll drop down to a 5. And let's say that we have a brand new hour candle, right? And we see that this hour candle needs to come down. So we're in a market like this. We're making lower highs. And we're about at this point here, right? So we know that a brand new 1 hour candle is forming. And what this 1 hour candle looks like on a shorter time frame might be something like this, right? Where it starts going up, creating what we say is a top wick, and then it will come down, right? And so what you could do is you could enter off of it flipping. So in real time, the candle could flip, and that's your entry point. But it's something that we'll explain a bit deeper when we look at entries and how to actually enter and exit the market, but it's important that you understand it. Do you have anything else to add on to that, Nathan, or candles in general?
No, dude, I think you've honestly kind of hit it on the head. The one thing that I probably will just say very quickly is that just with the candles, I think two very underrated candlestick patterns are the tweezer formations as well. You essentially, when you're looking for your entries, I know for myself, and I think Najat is probably the same. Essentially, with my entries, I'm sitting on the 1 hour and I'm looking for those top wicks. If a candle comes out and I'm looking for longs or I'm looking for sells, but we're in a bear market. So, for example, if the candle's going down and it's at the bottom and I'm waiting to go long or I'm waiting to buy, I'll wait for on the first hour the hourly to wick down and then start to retrace back up. But then also on the next hourly, I'll wait for the market itself to come down to that wick, almost bottom or become level with that wick there on those two tweezer examples, and then start pushing its way back up. So it's a good way to get entries when you can see that a double bottom has created. This is probably something we'll go into a bit later down the track as well, with a bit more market structure and structure as a whole. But that's another confluence. If you see something double bottom, it fails to break through twice, then you can have a good idea that it's about to reverse and start to push its way into the direction that you're wanting it to go. So your bias type of thing. So yeah, that's probably all I've got to add on that, to be honest, man.
Yeah, it's candlesticks is it's so important, and like a lot of like I said before, a lot of people trade purely candlesticks, right? It's the more we talk about candlesticks and the more examples we give you and the more you understand about what the candlesticks are telling you, is that's when you can take advantage of it a lot more, and it can help you to get better entries. It can help you, it can show you, let's say you're in a trade and you see a bearish reversal candle. Let's say you're in a buy and you see a bearish reversal candle. That's an indication that the buying pressure has stopped, right? So that could tell you, hey, maybe I should close my position here, take my profits early because this is going to come back down now.
Exactly. So look, I'd probably say that the wicks are almost as more important than the bodies themselves, because the wicks will give you indication where the trend will start to lose momentum and lose steam before it actually does, or before it's about to reverse. It will start showing you where things are about to start going, or it starts to wanting to go in the opposite direction. That's also where we plot a lot of these rectangles that you're seeing on our charts. It's a big part of that is because of the wicks and the rejections from those wicks.
The ugly chart for everyone to look at.
A little bit messy, but yeah, the wicks are probably as important as the bodies, if not more important. This is one thing that it took me a little bit longer to learn. I was teaching myself, so it did take a bit longer, but the wicks are probably the thing you want to be looking at more than the bodies themselves. The bodies are an indication of strength, but you want to be looking at the indication of weakness, especially for your positions.
Which is like right here, right? So we have like wicks coming to this range, and then the next candle can't even get into that range. It shows that there's so much selling pressure here that every time price came into it, it got sold off.
Yeah.
So this could be a potential area where, if price decides to come back up into this area, that's when we could sell. So we'll take a short and you would ride this down to here, right? Potential position.
So
as simple as that.
Even if I just look at my chart quickly, we've got these rectangles kind of plotted. This one was plotted before, but you can see that the price has actually come up. It's wicked in this box, so it's respected the actual level itself, but it's failed to break above. And then the next candle was a big red one, pushed straight down. Same thing here, 2 wicks up, it's pushed up, but it's wicked up here. then you've got another wick here, in like just giving you the incentive that it's about to keep pushing down, close red, and keeps pushing down. So yeah, wicks. We're pressing on this quite a bit, but it's probably one of the most important topics when it does come to trading, because it really does make up 90% of what you're seeing, 100% almost, 99%.
Exactly.
So it's really important that you guys can really nail the basics. So when we start actually touching on anything price action and just, yeah, price action wise, then it makes it a whole lot easier, because you can kind of see where things are reacting, and there's major shifts within the market at certain levels and stuff like that. But yeah, that will come with time. But yeah, I think that's pretty much it up from me with the candles
Yeah.
like that.
Knowing we only have like 10 minutes left, we'll give you guys time to, because we know we just dropped so much shit on you guys.
Yeah, we
So
kind of went a
if you
little
have
bit
any questions,
harder this time. But yeah, if you guys do have questions and stuff.
Are you gonna be
oh,
trading tomorrow night?
wait, you cut out, UB.
Sorry, are you gonna be trading tomorrow night?
Yeah, man.
Yeah, of course, every day.
We'll probably put in before we actually get on the live. So generally we're going to try and aim for 6:30.
Okay, easy.
But sometimes we might get on a bit earlier just to see what London Open's looking like and stuff like that. But yeah,
Yeah, so like we said yesterday, you kind of want to be looking at the charts during those important times, right? Like news, like session opens, or what's ever in your trading plan. So for me, I'll look at Asian Open. So I'll be on the charts around 9 a.m. to about 10 a.m. I'll look for a position there. Like today, this morning, I got a position there. And then if I'm in a position, I'll keep an eye on the charts. More so, I'll set alerts, because you don't want to just be kind of watching price, because that's when your psychology, going back to psychology, but that's where your psychology comes into play.
start getting your own head.
Yeah, and then you take a break, come back for London, or just trade really whenever suits you in the day. But coming from us, you want to trade when there's volume in the market. And we know that there's volume in the market at session opens. So just take advantage of it.
Anyone else got some questions?
I had a quick question. I was wondering, when you're like taking a trade, is it instantaneous? Like, are you when you're like buying or selling, like, do you click a button and you're instantly able to make that trade, or do you kind of have to wait for someone to then buy or sell what you're offering?
No. So you generally get filled straight away. There's two separate things that will probably go into next week. But essentially, when you get filled, you'll get your position will get moved by either your spread or your slippage. But you will get filled straight away, and there's different types of entries that you can do. So yeah, there's three different types. There's a market execution. So this is probably the one that you'll probably be using most of the time. Your market execution will essentially fill you in the position that you're in straight away. If you're trading news, then you probably won't get filled straight away. It might take a few seconds to get filled, and you might not get filled at the price that you're really wanting as well. That's probably when there's really high volume, but then there's also limit orders and stop orders. So that will essentially mean that you can pick a point on the chart, and then once price moves up to that point, then you'll get filled at that point in time. So say where Najat's got his position at the moment, if he wanted to put a limit order there, and price came up and then it rejected that point that he says, he will only get filled when price actually comes up to that point. So he won't get filled before You might get filled, or you could get filled after, but yeah, he'll only get filled at that point. So yeah, essentially your market executions will mean that you get filled instantly.
Yeah.
Yeah, so the problem with like, so when we say like spread and getting slipped, we mean that when price so here on the screen, right, you guys can see I set a sell limit here, which means that when price comes back up to touch this red line here, I'll execute a sell order, right? So it's automatically going to execute when price gets there. Let's say price shoots up here, I could get filled at various different places. So although I wanted to get filled at this level here at $1 at 9353, my actual fill could be somewhere down here, right? And this is purely kind of what you were questioning, Kate. It's someone needs to be the seller, or someone needs to be on the other side of my transaction. If that. So a lot of the times you'll get it nice, so you won't get slipped too hard. But when price is moving really quickly, that's when you can get like fucked over pretty much by
Yeah.
something like that.
Essentially, as well, when there is a lot of activity in the markets, the brokers will try and protect themselves by putting the spreads up a bit more, so that they can essentially just not take as much of the volume, but people obviously will still be making orders and stuff like that. But yeah, we'll get into spread and stuff like that next week. What's that, Kate?
Okay, cool. I was just wondering, like, who are these brokers and what's their position in the market? Like,
so essentially, a broker, we make our trades through a broker, so we can't make them ourselves.
Right.
The broker will allow us to execute our own trades. So we use MetaTrader, or not MetaTrader. We use TradingView to actually do the analysis. So that's what Najat's on now. But then to actually execute the trades themselves, we have to use a broker. I think a really popular one in Australia is called 8Cap, and they essentially execute the orders for us. So we can put a buy order on a different application once we start looking at getting trades done. But yeah, they'll essentially buy or sell the order for us. So it's a bit weird, like just wrapping your head around that I'm pressing the buy on my actual app itself, but then they're actually executing the order for us. But the brokers just buy and sell for us, but we just tell them when to buy and when to sell.
nice. So the brokers are real people, or are they like bots?
Honestly,
Bots.
yeah, I was going to say I'm sure, but I think back in the day it used to be people, but these days it's
Yeah,
probably...
back in the day it would have been like Wolf of Wall Street spec, where like you like call up
Yeah.
and like someone's like actually handling it. But now because of like online trading, it's all bots. So it's very instant now.
And do the brokers get a cut of your profit or
Nah. So they get commission or spread, which is what Nathan kind of said before. So like to protect themselves, it's a very small amount. Different brokers have different commissions and spreads. And commissions and spreads also vary with the pairs you trade. So this will confuse you guys, but as a gold trader, I don't pay any commissions, but I pay a lot more in spreads. Meaning that if I want to buy $100, I'll probably actually buy it like $101. But let's say if I'm trading the euro, and if I buy 10 lots, I'll have a commission of $7 per lot that I have to pay.
Yeah, it will just come out. So essentially, if you get stopped out or you win your trade, there will be like a certain percentage that just gets taken out automatically. So you will know it's there, but also you won't really too much.
Yeah. What will really like, if you ever are trading during what we call spread hour, so this is after New York session and before Asian session. So this is like when the day technically changes in terms of the charts. This is where you pay the most fees. So for instance, I made a trade the other day where I was up 2%, but I had to pay 1% in fees because I held my trade over this period of time. Yeah.
As well as this is probably why we both trade the London and the New York Opens and sessions as well. That's generally where your spreads will be a lot lower. Your key emissions will probably be the same, but your spreads will be a lot lower because there's a lot more people coming into the market, if that does make sense.
Yeah, see, if you look at my screen now, you can see like the actual spreads from 8cap. So this is a big broker in Australia. You can see Euro USD, there's zero spread. So because it's a very popular currency and a popular pair, and there's lots of volume in it, they offer a zero spread. You look down, you look at gold, and there's 12 cents USD in spread. You look at Bitcoin, and you have $12 here in spread, and so on and so forth. These are your different markets, shows you different spread, and all of that jazz.
And sorry, just to clarify, spread is like kind of commission, like what the broker is.
So your spread will be essentially, it's your spread's the difference between the ask and the bid, so the buy and the sell price. But essentially, it will just fill you. You'll try and get in at a price, but it will just fill you at a maybe a lower or a higher kind of price as well. Essentially, just keeping it basic. So your spread, you essentially want to account for it, but you also want to have as small of a spread as possible when trading too.
Yeah. We can, when we go into the actual like broker that we use, I can show you guys like actually like real time what spreads look like and what commissions look like.
Can you?
But over time, you'll kind of assume it.
Have you got your MetaTrader?
I do, but I don't want to open it, man. It's gonna be way too confusing.
Okay, fair enough. No, that's no drama.
Like think about the first time you open MetaTrader. Very scary looking app, right?
Honestly, even now it's still scary. I just like the mobile version.
It's very ancient. Honestly, I'll just open it because
Yeah,
we just talked about it. So I'll give you guys a quick sneak peek.
Ancient.
So this is what you guys, this is what you actually trade off of.
So this is your broker, or this is where you submit your trades to your broker.
Yeah, so you have your buy, your sell.
See, I'll show
you.
you.
Have all your pairs.
So there's this, but then there's also like this.
Yeah. On the phone, it's a lot more simple.
On the phone, it's just hold on. It's just.
Yeah, that shit looks archaic.
Yeah, so this is it on the phone. So you sell here, you buy here, and then you put in your lot size up here.
Yeah.
Yeah.
This shit is very ancient. Well, honestly, once like maybe in like the 5th week, we'll take you guys through how to actually like operate MetaTrader, because there's like when you first go into it, yeah, it's pretty hard to navigate. But once you know what you're doing on it, it's very straightforward. But that's why, see how like ugly this chart looks? That's why we do our analysis on TradingView.
Yeah, and
then we go to our broker just to buy or sell.
Yeah, it's just nicer. Alright. Has anyone got any more questions?
Oh, I was just quickly going to ask, like where you guys sit on that sort of, like winning percentage, kind of like where you sort of want to see, like, you know, I think you were talking earlier about some people want to win like only 20% and that will put them in profit, or like, you know, win maybe 80% and that will, you know, just put them in profit or something. Do you guys kind of see maybe like 50%, like that kind of, you aim for that, or?
Yeah, so I did some back testing on mine, and my strategy was around 60 to 70% win rate. So for me, I hate losing. So like, if I'm looking at taking like 5 trades, and I know that if one of them wins, then my win will outweigh my loss. I can't really resonate with that as much as just winning flat out, if that makes sense.
Yeah.
So for me, it's a bit more on the win rate side. I think for Nathan, he usually goes for those 1 to 2s. So he's probably at like 50% win rate. I don't know, Nathan, if you want to.
Yeah, I think I'm about 55 to 60 when I did backtest a little while ago. But yeah, for me, I like to just get it to like a win rate to like 1 to 2.5 R. So essentially, for every 100, I like to try and get 250, just to make it kind of worth it. But obviously, when you're seeing your charts and things like that as well, you can kind of take your losses early and you can see things happening and stuff like that. But yeah, essentially for me, I like my risk and reward around the 2.5.
Yeah, and the thing about win rates as well is, so a lot of the time when we enter a position like the one on the screen, right? So the black area is what we consider UN drawdown. So where this line is where we've entered, right? So if we're in the black, it means we're losing. If we're in the blue, it means we're winning, right? So when price gets to, let's say I've entered here, when price gets to a decent level, or if I'm in profit a substantial amount, what you would do is you'll make your stop loss your entry point. So then technically the trade's now risk free. But a lot of the time what will happen with your trades is you will see that you get stopped out at break even, right? So all of these like little things will tamper with your win rate. So you could be a really good win rate trader, but like, 10 of those trades could be break even at like $1, if that makes sense.
Yeah. Okay.
Yeah, once we do backtesting, Lewis, you'll be able to see what your strategy proves to you. Because if you backtest and you have a 20% win rate, but you've got profit of like $10,000, then you know that you're not a win rate trader and you can fuck the win rate off. Because you know that even with a 20% win rate, you're still profitable in the long run, right?
Yeah. Yeah.
Yeah, so
But it is a
essentially,
good question.
yeah, it's more of the long term kind of game trading. So like I feel like with people there's this stigma behind it saying that you're gonna get rich overnight. Look, you might have one day where it changes your life, but yeah, it's gonna take a little while to kind of build up those accounts and get those bigger trades kind of rolling in. But eventually, once you guys start looking at doing things like getting funded and things like that, you could be doing $2,000 a trade.
Yeah.
I think the
So
biggest.
that pretty much like that. So this pretty much wraps up. This week kind of wraps up market structure and candlesticks, and we did that on purpose. So next week, from now on, pretty much we'll do a lot of charting.
Yeah,
So we'll do a lot of the different technicals.
I think next week we're just gonna go into a little bit on just pips, so how you value your trade, how you can get your R&R, how you can figure out what your trade's actually worth, and then from there we're just gonna start just going hard at technical analysis.
Yeah. Once you guys understand what position sizes are, what your account balance is, and what this all means, then all of these like all these questions will make a lot more sense, and things will start to kind of click by then. Once you understand how we actually like size our positions and stuff like that.
Yeah, how you actually make money in trading and like what kind of potential gains you can make. Because I feel like we said last time that this is probably the only job that you can do with really untapped potential. How far you want to take it is really how far you're going to go. But next week we'll show you on how you can actually make the money and how much money you can really make from this shit as well. So yes.
Was there anything else? Any other questions? I guess between now and Tuesday, just make sure you guys are like comfortable with market structure, comfortable with candlesticks. Of course, like next week, you guys can ask for a refresher and we'll give you a refresher. But a lot of this is like we're teaching you the core, and where you guys see gaps, you either feel free to ask us and we'll take you through it, or just search the internet. There's lots of resources that you can just like refine your understanding of certain concepts. Or if Nathan and I have explained it in a dumb way, then you can get it explained to you in a better way that might make more sense. But next week will be like the nitty and gritty. Next week you guys will really see like, okay, so this is what they do when they jump on the charts. This is how the market moves.
Yeah, even if you guys want, even like once, one maybe more next week than anything, because we'll start looking at how market structure works. But even jump into like a live stream, we'll go live for like an hour. We play some tunes and shit like that. And yeah, we just kind of go through while we're making moves, what we're really looking for, and it'll just start making a bit more sense. See us take the L and see us get real mad at the charts, and yeah, good
Yeah,
fight.
that's when the fun happens.
That's when the depression is.
But it was a good session. I think yeah, so I'm guessing there's no other questions, guys, or is there anything that anyone needs help with understanding before we wrap up?
Oh, just a separate thing. I signed up pretty late, so could you guys just send the pack and stuff you sent to everyone else?
Yeah, of course, man. Did you put your email in?
Yeah, I did do the form in the end, but I did it like half an hour before the first stream. So yeah.
All good, man. We'll send everything for you, man.
Thank you.
Easy, brother. Have
Easy.
have a read through everything and just make sure it makes a bit of sense. And yeah, we just help to have in front of you when we're going to do these calls as well.
Yeah.
Yeah.
And then if you guys want resources like, you know, because both Nathan and I learnt from pretty much the internet, right? Like I did learn from Nathan, but then a lot of it was just on the internet doing my own learning. So we've gone through like a lot of resources. So if you guys want resources, we're happy to provide them. You know, if you want to do additional and kind of understand on a deeper level, because everything we're explaining, we're kind of explaining what we think is the important part, as well as like essential parts of the process. But there's definitely going to be things that we kind of brush over that, you know, it wouldn't hurt for you guys to be aware of and whatnot.
Juicy.
But easy.
All right,
I think
guys.
we wrap it up there, guys.
If you guys don't have any
Sick.
other
Thank you
anything
so
else,
much, guys.
it's no dramas. We'll see you all next
Yeah.
week.
Yeah.
If you guys think of anything that you want to ask over the weekend, like honestly, our inboxes are open 24/7, so just shoot us a message. But yeah, in that
Yeah,
case,
even use this chat, guys. Like whenever something comes up, or like, you know, if you're doing your own research and you're not sure of something, use the chat function here, and we'll jump in whenever,
and
you know,
honestly,
and answer.
I think next week as well, we'll probably get you guys looking at just the demo accounts on actual TradingView itself, just because the more you're actually on the charts and the more you're looking at things, the easier these things are going to become. At first, you're going to think this is all a bunch of randomness, but yeah, it's going to start making sense pretty soon.
Yeah, and once you start placing trades and seeing green numbers, you guys will become addicted very quickly.
You'll get
So-
you'll get on it. You'll love it.
So just mentally prepare for that part.
Yeah.
But sweet.
All right, guys.
Have a good night, everyone.
Bring back the beard.
Bring back the beard.
Bring back me. I shaved it yesterday, man. Looking like a little boy. It was a mistake.
Look clean. Man.
Not gonna put my webcam on until it goes back. The depression.
Guys, thank you.
Have a good weekend, everyone.
Enjoy your weekend, and yeah, we'll be chatting to you guys next week.
Thanks, guys.
No worries, guys. Enjoy.
Sick. Thanks, guys.
Bye, everyone.
No worries at all.
Bye.
Ciao. Bro, that was fucking